Welcome back to the Deep Dive. Today we're tackling Coinbase Global, ticker COIN, and their Q3 2025 earnings. We've got the full analyst breakdown here.
Yeah, and this isn't just the press release. Our source material uses a pretty structured five-part framework. It's what analysts use to really compare the official numbers against what the market was actually expecting. And the headline, quote from the analysis, exceptionally strong top-line growth and an even more pronounced expansion in profitability. That definitely sets the stage.
It really does. And our job today, for you listening, isn't just to say, wow, big numbers. It's to get underneath that. We want to understand why it happened. What's driving the performance? What's management actually doing strategically?
Yeah.
Because understanding that structure, how the business scales efficiently, that's key, especially in a space like crypto infrastructure that moves so fast. This framework helps keep it clear. Exactly. Think of it as our roadmap. We're cutting through the jargon and the dense tables to get straight to what matters.
Okay, let's unpack this. Starting with slide 1, the at-a-glance scorecard. So right off the bat, the numbers just look incredibly strong. A really significant beat on both revenue and earnings. It points to a very healthy operating environment during the quarter.
Absolutely. And when you look year over year, the growth is pretty dramatic. Total revenue hit, what was it? $868.7 million. That's up 55.1%. Strong growth.
Strong is one word for it. But the profitability, that's where things went kind of nuts.
Completely. Net income jumped 479% compared to last year. But the number investors really focus on, diluted EPS, that came in at $1.50, and that's up 435.7%.
Okay, remind us quickly why diluted EPS specifically, not basic.
Right. So diluted EPS is the more conservative figure. It assumes that all potential shares, stock options, convertible debt, everything that could become a common share actually do convert. It shows the potential impact of all that dilution on earnings per share. It's kind of the worst case earnings per share number. Got it. So even the worst case scenario was $1.50. And how did that stack up against expectations?
It crushed them. The consensus estimate on Wall Street was around $1.13 for diluted EPS. So $1.50 was a huge beat. Revenue was also well above the $1.79 billion consensus analysts were looking for.
So massive operational beat. But here's where it gets really interesting. The stock didn't really react much immediately after the announcement. It was down slightly, 0.60% in after hours.
Yeah, that's the puzzle, isn't it? When you see numbers this good, you expect a pop. It could mean a few things. Maybe the market had already baked in perfection. Maybe investors were looking past the quarter at something else, like future guidance, or maybe that dilution we just mentioned.
Or maybe the operating leverage story is just that complex.
Well, that operating leverage is definitely the core operational story here. That's the engine behind the huge gap between revenue growing 55% and EPS growing, over 400%. Basically, it means their revenue grew much, much faster than their costs. Total operating expenses were only up 34% year over year. When revenue outpaces costs like that, your profit margins expand significantly.
Right. So things like their tech platform, maybe their core administrative staff, those costs didn't have to scale up nearly as much as the trading volume and revenue did. More profit falls to the bottom line.
Precisely. And here's a crucial detail. This huge EPS growth happened even though their weighted average diluted share count went up by 9.2%.
Up. Why was that?
Mostly because of the shares they issued for the Deribit acquisition, about 11 million shares. So they had this headwind of more shares outstanding, which normally pushes EPS down. But the operational earnings were so strong, they powered right through it. It wasn't financial engineering. It was core business performance.
That's a really important point. So the market might be seeing the dilution, but the underlying engine is firing on all cylinders. Okay, let's shift gears. Moving to slide 2, the engine of profitability. We talked about operating leverage. Let's put a number on that efficiency gain. The operating margin tells the story, right?
It does. It went from 14.1% in Q3 of last year, 2024, up to 25.7% in this quarter, Q3 2025. That's an expansion of more than 11 percentage points. That quantifies the leverage perfectly.
Now, profitability reporting. There's always GAAP and non-GAAP. Can you quickly break that down?
Sure. So GAAP, generally accepted accounting principles, that's the standard official way companies have to report. It ensures consistency. Non-GAAP is management saying, okay, here are the official numbers, but let's adjust for some items that might be volatile or aren't part of our core ongoing operations so you can see the underlying health.
Right. So what were the big adjustments for Coinbase this quarter?
The main ones were related to the crypto holdings. They took out about $424 million in unrealized pre-tax gains. So assets went up in value, but they haven't sold them. but they also excluded around $400 million in pre-tax losses on other investments. Netting those out gives you what they call adjusted net income. It came in at $421 million, which was actually pretty close to the GAAP net income of $433 million this time. Sometimes that gap is much wider.
Okay, what about adjusted EBITDA? That number always seems quite high. It was $801 million.
Yeah, adjusted EBITDA is earnings before interest, taxes, depreciation, and amortization, plus other adjustments. The big difference between that $801 million and the GAAP net income often comes down to add-backs. And the most significant add-back for Coinbase, consistently, is stock-based compensation, or SBC. It was $222.1 million this quarter.
Ah, SBC. So paying employees with stock.
Exactly. It's a non-cash expense, so it doesn't hit their immediate cash flow, which is why it gets added back for EBITDA. But, and this is a big but for investors, it represents future dilution. Those shares eventually increase the total share count. So while the operating profit looks great, you have to keep an eye on SBC as a potential drag on future EPS growth.
Definitely a key risk factor to track.
Okay.
Okay, let's look under the hood. Now we look under the hood at the actual revenue sources with slide 3, the engine room business segment performance. Transaction revenue, still the biggest piece of the pie, right? And it grew massively, 82.8% year over year.
Yeah, still the core engine. And that growth came from both sides. Consumer revenue was up a strong 74.5%. The analysis noted that was partly driven by users moving to their advanced trading platform, which typically has lower fees but drives volume.
And institutional.
That's where the explosion was. Institutional revenue jumped 144.1% year over year. But you have to unpack that number.
Okay, what's inside?
M&A, specifically the Deribit acquisition, which closed during the quarter. Deribit is a huge player in global crypto options and futures. They contributed $52 million to Coinbase's institutional revenue line out of a total of $135 million.
Ah, okay, so without Deribit?
Without Deribit, the underlying institutional growth was closer to 49.9%, still very healthy, but not 144%. It really highlights how central acquisitions are to their strategy now.
The everything exchange vision, as they call it.
Exactly. This isn't just about growing organically anymore. They're actively buying pieces to build out this global, comprehensive platform, spot trading, custody, staking, yield, and now, thanks to Deribit, a major global derivatives capability. They want to be the infrastructure for everything crypto, everywhere.
Makes sense, and that ties into the other big revenue bucket, subscription and services. That's the more stable, recurring part.
Correct. And that grew a solid 34.3% year over year. This is becoming increasingly important for smoothing out the volatility of trading revenue.
And within that, stablecoin revenue was the fastest grower, up 43.7%.
Yes, that's tied directly to USDC. The market cap of USDC hit $74 billion, and Coinbase held record average balances over $15 billion on their platform. They generate revenue from the interest earned on the reserves backing those stablecoins.
That sounds like the ecosystem flywheel they talk about.
It absolutely is. It's not just diversification. When users hold large USDC balances, Coinbase earns steady, high-margin revenue. And critically, it makes users stickier. If your stablecoins are already there, you're much more likely to do your trading there too. It fuels the whole ecosystem.
Very powerful dynamic. Okay, let's turn to the balance sheet, health, and capital allocation strategy with slide 4. Financial strength and shareholder rewards. The report describes the balance sheet as strong and conservatively managed. What metrics back that up?
Well, a key one is the debt-to-equity ratio. It came in at 0.96. Anything below 1.0 is generally considered healthy, meaning the company finances itself more with owner's equity than with borrowed money.
Which is probably prudent in the crypto space, right, given the volatility and regulatory uncertainty.
Definitely. You don't want to be over-leveraged heading into a potential downturn or regulatory crackdown. It signals good risk management.
And they seem to have plenty of cash on hand.
Oh yeah, massive liquidity. They reported $11.9 billion in what they call USD resources, that's actual cash, USDC holdings, and money market funds. Total resources, including crypto assets, were $15.5 billion. That gives them huge flexibility for acquisitions, investments, or just weathering storms.
And how are they deploying that capital? Shareholder rewards.
They doubled their share repurchase authorization to $2.0 billion. That's significant, but the really unique part is how they authorized it.
How so?
The board gave management the flexibility to repurchase not just common stock, but also their long-term debt.
Buying back their own debt. Why do that instead of just buying stock to boost the share price?
It's actually a very savvy, disciplined move. It signals that management isn't just focused on the short-term cosmetic effect of reducing the share count. They're looking holistically at the balance sheet. If market conditions change and their own bonds are trading cheaply, buying them back is a low-risk way to reduce future interest payments and effectively earn a return by retiring debt below face value. It strengthens the company's financial foundation. It's a sign of mature, prudent capital management.
That is interesting. Shows a focus beyond just the next quarter's EPS number.
Hmm.
All right, finally, let's look forward with slide 5. The road ahead management's outlook and key takeaways. Did they give specific numbers for Q4?
They did give some quantitative guidance. For subscription and services revenue, they expect continued strength, guiding for $710 million to $790 million. But they also flagged higher expenses. Tech and development plus G&A expenses combined are projected between $925 million and $975 million.
Why the jump in cost?
They attributed it mainly to integrating recent acquisitions like Deribit and needing to hire more people to support the expanded global operations and product roadmap. Growing pains eventually, but necessary ones for their strategy.
And qualitatively, what was the overall message from management?
Very bullish on the long-term vision. A CEO commentary really hammered home the everything exchange strategy. They used phrases like regulatory clarity accelerating, suggesting headwinds are easing, and crypto rails are set to power more of global GDP. The message was clear. They feel Q3 proved their strategy is working, and they're positioned to lead this next phase.
So wrapping it all up, what are the main takeaways from this quarter?
I think there are 4 big ones. 1, explosive profitability driven by that operating leverage. They prove they can mint money when volumes are strong. 2, acquisitions are now a core strategic growth engine, not just opportunistic plays. Deribit proves that. 3, the ecosystem flywheel, especially with stablecoins, is really working. It's creating that sticky, recurring revenue base. And 4, prudent and flexible capital management, highlighted by that dual stock debt buyback program. It shows discipline.
So the big picture is that this wasn't just a lucky quarter driven by market swings. It was the result of deliberate strategy execution M&A, building the ecosystem, watching costs, and that move into global derivatives with Deribit. That feels like a major strategic shift.
It is.
It really prompts the question for anyone watching Coinbase. How does aggressively pushing into complex global derivatives fundamentally change the risk profile and the potential reward profile of this company long term? That seems like the key thing to watch going forward. Okay, before we close out, the necessary reminders. This discussion is not financial advice. Please always do your own research before making any investment decisions. This report was generated by AI. Like and subscribe to stockanalytics.ai. YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.